The fate of the interest rate cap lies with members of parliament, with the president having made a U-turn and now backing the repealing of the law, which has been detrimental to Kenya's economy. MPs have 21 days to determine which way forward with the rate cap, with 2/3 of the majority required to keep it in place. Victor Kiprop now reports on the part that led to the president's change of heart after 3 years, despite mounting evidence from the time it was put in place that it was not achieving the intended objective.
Opposition to the interest rate cap law, which limits the level of interest that banks can charge on their customers, began as soon as it was proposed on the floor of the House. Political considerations, however, saw it sail through the legislative process and eventually became a law. The Central Bank of Kenya, however, had from the onset raised objections to the cap.
Data will show that it is quite damaging to the economy, it's quite damaging to our own people. The people that we expected to help are the ones that are hurt the most.
But after 3 years of borrowing at fixed interest rates that have averaged at between 13 and 14%, Kenyans might soon have to pay more for loans if Parliament is unable to mount sufficient opposition to the president's wish. According to the Kenya Bankers Association, the micro, small and medium enterprise segment of the economy used to grow by 15% per annum prior to the rate cap, but has reduced to 6% when the caps were introduced. Simply put, the rate cap benefited big players and corporations at the expense of millions of Kenyans hustling to make it.
The reduction of credits to the private sector, particularly micro, small and medium enterprises. 2, the decline in economic growth. 3, the weakening of the effectiveness of monetary policy. 4, the reduction of loan advances by banks. 5, the mushrooming of Shylocks and other unregulated lenders.
Kenya has lost a lot of its growth dynamism by an interest rate, loan rate cap and interest rate structure that doesn't ultimately serve its economic needs.
Members of Parliament who had already rejected a request by the National Treasury to remove the cap in June have vowed to overturn the president's directive. Meanwhile, experts argue that the credit squeeze in the country is tied to the government's fiscal indiscipline.
About 2004, 2005, interest rates in this country were really favorable. People started to go back to lending, and banks expanded by actually focusing on the lower end of the market. It is possible for that to happen again. But if you have a government that wants to borrow 1 billion shillings a day from the domestic market, few of those people who actually hold resources and they have to pay a return, and they also have to pay those risks, will be willing to give to a person who just simply wants some 500,000-600,000 shillings.
The National Assembly has 21 days to consider the president's reservations in the memorandum, failure to which the directive will become law, taking the country back to a market-determined interest rates regime. Victor Kiprop, NTV Business.
And staying with that story, it has been a relatively good week for shareholders of listed banks as the counters posted a price gain during Friday's trade compared to the close of last week. On the whole, the market value of listed banks gained by 22 billion shillings compared to last week, accounting for 20% of the total market value gain at the stock exchange week on week. This comes as investors increase their appetite for banking stocks in anticipation of a possible repeal of the law capping interest rates following the president's memo to the National Assembly on the Finance Bill of 2019. The biggest gainers among banks were NCBA, whose price appreciated by 10.2% compared to last week's close, and I&M Bank, which went up by 6.3%.